balance sheet. From this information, we need to calculate current ratio, liquid ratio and debt equity ratio. Gross profit ratio is equals to gross profit divided by net sales into 100. For liquid ratio, formula is quick assets divided by current liability. Hello everyone, I am Meghana from the Department of Commerce, lecturing in Vidhyaashram First Grade College, the Temple of Excellence. We are in the session 3 of Unit 2, subject accounting. In the last session, we have discussed about ratio analysis and we solved 2 problems on ratio analysis. In today's session, let us continue with the problems on ratio analysis. First problem, following is the balance sheet of Satya Limited as on 31st/3/2019. This is the balance sheet of Satya Limited. Under liabilities, we have equity share capital 2 lakh, reserves and surplus 1 lakh, 10% debentures 1,50,000, sundry creditors 25,000, provision for taxation 5,000. In asset side, fixed assets 4 lakh, stock 20,000, sundry debtors 30,000, cash at bank 20,000, prepaid expenses 10,000. So we have balance sheet. From this information, we need to calculate current ratio, liquid ratio and debt equity ratio. First one, current ratio. We know the formula for current ratio. Current ratio is equals to current assets divided by current liability. In the last class, we have discussed about the current ratio. What is current ratio? Why we need to calculate the current ratio? In the last class, we have discussed all this information about current ratio. Current ratio is equals to current assets by current liability. First, you need to identify the current assets and current liability in this problem. Current assets, sundry debtors, current asset, then cash at bank, current assets, prepaid expenses, current assets. Then current liability, sundry creditors, provision for taxation. We have 2 current liability and 4 current assets. The total of current assets divided by total of current liability is equals to current ratio. Let's calculate the current ratio first. First ratio, current ratio is equals to current assets divided by current liabilities. So first, current assets. Current assets is equals to, in this problem we have stock, sundry debtors, cash at bank and prepaid expenses. Right? Stock plus debtors, that is sundry debtors, plus cash at bank plus prepaid expenses. Stock rupees 20,000, sundry debtors 30,000, stock rupees 20,000, debtors 30,000, cash at bank 20,000 plus prepaid expenses 10,000. 20,000, 10,000. Total current assets is equals to 20,000 plus 30,000 plus 20,000 plus 10,000, that is 80,000. Total current assets is equals to 80,000. Next, calculate current liability. current liabilities is equals to creditors plus provision for taxation. Creditors plus provision for taxation. Creditors is equals to, creditors is 25,000 plus provision for taxation is 5,000. Total 30,000 is current liability. 25,000 is creditors and provision for taxation is 5,000. Total 30,000. Now we have current assets and current liability. Let's calculate current ratio. Current ratio is equals to current assets, that is 80,000 divided by current liability, that is 30,000. 80,000 divided by 30,000 is equals to 2.67. So the current ratio will express in the form of 2.67 is to 1 is your current ratio. Current ratio is 2.67 is to 1. Current ratio we calculated. Then liquid ratio. For liquid ratio, formula is quick assets divided by current liability. Next, liquid ratio. Liquid ratio is equals to quick asset divided by current liability. We have current liability. Current liability is 30,000. Current liability is 30,000. So we have current liability, but we don't have quick assets. We have current assets. Quick assets is equals to current assets minus stock plus prepaid expenses. In this problem, the total current assets is equals to 80,000. Total current assets is equals to 80,000 minus stock. Here, stock is 20,000. Then prepaid expenses 10,000. 20,000 is stock plus 10,000 prepaid expenses. So 80,000 minus 30,000 is equals to 50,000. 50,000 is quick assets. Now we have quick assets and current liability. Just calculate liquid ratio. Liquid ratio is equals to quick assets, that is 50,000 divided by current liability. Current liability is 30,000. So right, 30,000. Now the liquid ratio is equals to 1.67 is to 1. 1.67 is to 1 is liquid ratio. Next, debt equity ratio. Next one, debt equity ratio. The formula is debt divided by equity. For this calculation, debt, it includes total liability, that is 10% debenture, sundry creditors and provision for taxation. 1,50,000, 25,000 plus 5,000. Debt is equals to 10% debenture plus creditors plus provision for taxation. Provision for taxation. 10% debenture is 1,50,000 plus creditors is 25,000 plus provision for taxation is 5,000. Total 1,80,000. 1,80,000 is debt. Next, calculate equity. Equity include equity share capital plus reserves and surplus. Equity share capital plus reserve and surplus. Equity share capital is 2 lakh. Equity share capital 2 lakh plus reserve and surplus 1 lakh. Total equity is 3 lakh. Now we have debt and equity. Now we can calculate debt equity ratio. Debt equity ratio is equals to debt by equity, that is 1,80,000 divided by 3 lakh, that is 1,80,000 divided by 3 lakh. The answer is debt equity ratio is equals to 0.6:1. We finished with current ratio, liquid ratio and debt equity ratio. For this problem, current ratio is 2.6:1. The ideal ratio is 2:1. Next, liquid ratio. Liquid ratio is 1.67:1. The ideal ratio for liquid ratio is 1:1. Next, debt equity ratio. Debt equity ratio is 0.6:1. The ideal ratio for debt equity ratio is 2:1. So, first problem is over. Next, come to the second problem. Following trading and profit and loss account of Cadbury Limited for the year 31st/3/2019 is given below. The trading and profit and loss account. Here, opening stock, purchase, wages, carriage, then sales, closing stock. Here, gross profit. Gross profit is rupees 2 lakh. and net profit is 84,000. We have indirect expenses, administration expense, selling and distribution expense and non-operating expenses. Here we have non-operating income also. Gross profit is 2 lakh and net profit is 84,000. We need to calculate gross profit ratio, that is GP ratio, net profit ratio, NP ratio, then stock turnover ratio. First, calculate gross profit ratio. Solution. First, consider gross profit ratio. We know the formula for gross profit ratio. Gross profit ratio is equals to gross profit divided by net sales into 100. Gross profit ratio is equals to gross profit divided by net sales into 100. In this problem, we have gross profit rupees 2 lakh and net sales. Net sales is rupees 5 lakh. Net sales is equals to, we know the formula for net sales. Net sales is equals to total sales minus sales return. Sales return. But in this problem, we don't have any sales return. So 5 lakh is considered as a net sales. 2 lakh divided by 5 lakh. 2 lakh is gross profit. Just write gross profit ratio. Gross profit is 2 lakh divided by net sales. Net sales is 5 lakh into 100. Then 2 lakh divided by 5 lakh into 100. That is gross profit ratio is equals to 40%. So now we find gross profit ratio. Next, net profit ratio. Second one, NP ratio, that is net profit ratio. Net profit ratio is equals to net profit divided by net sales into 100. In this problem, we have net profit of rupees 84,000 and net sales is 5 lakh. Just write net profit 84,000 divided by net sales, that is 5 lakh into 100. Now the net profit ratio is 16.8%. 16.8% is net profit ratio. Next, stock turnover ratio. Stock turnover ratio we can calculate by considering cost of goods sold divided by average stock. To calculate cost of goods sold, we consider net sales minus gross profit. Net sales minus gross profit is equals to cost of goods sold. Then average stock. To calculate average stock, we consider opening stock plus closing stock divided by 2. So just calculate stock turnover ratio. Stock turnover ratio. Stock turnover ratio is equals to cost of goods sold divided by average stock. So, cost of goods sold can be calculated. Cost of goods sold is equals to net sales minus gross profit. So, in this problem, net sales is equals to 5 lakh. Net sales is equals to 5 lakh minus gross profit is 2 lakh. 3 lakh is cost of goods sold. Then average stock. Calculate average stock. Average stock is equals to opening stock plus closing stock divided by 2. Now write opening stock. Opening stock is 76,500 and closing stock is 98,500. 76,500 plus 98,500 divided by 2. The average stock is equals to 87,375. Average stock is equals to 87,000. Average stock is equals to 87,375. So now calculate stock turnover ratio. Stock turnover ratio is equals to cost of goods sold by average stock. Cost of goods sold is 3 lakh. 3 lakh divided by 87,375. 3 lakh divided by 87,375. Stock turnover ratio is equals to 3.43 times. So, in a year, 3.43 time is your stock is turned off. That means your stock turnover ratio is 3.43 times. This is first problem, current ratio, liquid ratio, debt equity ratio. Next, second problem. For this, gross profit ratio, net profit ratio, then stock turnover ratio. This is all about today's session. Let us meet in next session with some more problems on ratio analysis. Until then, keep watching. Thank you.